Waxler here with the always lovely and talented Andrea Kay, the always incredible Urban Miaris, and we are going to talk a little bit this segment about some of the topics in my book. I want to kind of go over a couple things because it's called Stop Bleeding Cash, and yes, you may have a copy.
Yes.
And you know, there's a lot of different things people can do to save money. You don't have to be self-employed. Self-employed people have a lot more options than your regular W-2 employees. Mm-hmm. But regardless of what you do, you know, there's a lot of ways to cut down on expenses that you don't need to have. Okay?
Yeah, I see that chapter 5 of the book is speaking of expenses, how to stop bleeding cash on your healthcare expenses. I don't know that we've ever broached that topic here.
We haven't, and by sheer coincidence, that was the one that I was ready to delve into.
Yay!
So how to stop the bleeding on your healthcare expenses. There's a number of ways you can do that. For example, you can set up, most people have a health insurance plan and they don't use it. They don't use it for all the things that you normally would. They have they use it for a few hundred or a few $1,000s a year. So if you want to, you can go to a high deductible health plan and put a health savings account in.
Okay. Which is what?
The health savings account is you're trying to save money on your health insurance cost because you don't use it as much, but you want it for the more catastrophic things. So if you have $1 million expense, you're covered, but if you have a few $1,000s, you're not. Okay. That's kind of the idea behind it. And if you can save most of that few $1,000s from the health insurance expense, then it works. What you do is you back that up with, if you're a single individual, I shouldn't say single, if you're a family versus an employer, you back that up with a health savings account. Health savings account works just like an IRA. You can put away a certain sum of money depending on what your family status is.
Pre-tax?
Pre-tax,
okay.
Fully deductible money that goes into a pre-tax account. You can sometimes, if you take the approach, you can even have it invested in certain kinds of funds to try to grow it while it's
okay.
Okay.
So it's not just like sitting in a bank account somewhere. You can actually even have it in maybe a mutual fund or something.
Yes, you can have it in a bank account or you can have it in a mutual fund. Okay. There's ways to do everything you want. Then when you incur an expense, let's say it's a copayment or it's a deductible or a prescription, whatever it is, you can turn around most of those health savings accounts will come with a debit card. You can walk into the facility, whether it's doctor or pharmacy, whatever it is, and pay for it with the debit card. What happens is you've gotten a deduction for the money that goes in, so that saves you tax dollars. Mm-hmm. If you spend that money on a qualified expense, again, prescription, medical, dental,
eyeglasses, stuff like that.
Anything that's qualified expense, you get that money out tax-free. So it's deductible in and tax-free out.
Wow, okay.
Well, I didn't know that.
Yeah, I didn't either.
And what happens with that money, what happens if let's say you get to 65, you pick up Medicare, you don't need it anymore because you've got everything covered, and you have many years of deposits and growth on those deposits, you can either use that to pay for long-term care insurance, or you can use that to cover, you can roll it over into an IRA and have additional retirement income.
Oh, my goodness.
Are there penalties, like pulling money out of an IRA?
There are penalties if you want to pull it out for a non-qualified expense, similar to an IRA. They might even be a little bit more egregious than an IRA. I have to look at that one more time.
So you can't just pull it out because you want to go buy a car,
right?
Necessarily,
right?
Or take a vacation.
Right. You use it for qualified expenses. It comes out tax-free. You get to age 65, if you want to roll it over into an IRA, then you can use it for supplemental income. Okay?
Oh, awesome.
So that's just one way.
Okay.
There's another way that I love, and most people are used to this in and we had Bill McCracken on a year and a half ago talking about this. Most people are used to what's called a flexible spending account. When you get into health insurance and health expenses, health insurance covers all of the expenses that you pay that are not attributable to a deductible or a maximum out of pocket. Okay, when you have an out of pocket expense for medical, dental, or vision care, that comes out of your pocket. You typically have to earn $1 to have 67 cents left to spend, whatever your tax bracket. right? So what happens with a flexible spending account is they allow you to save money out of your paycheck to pay these expenses.
A flexible savings account or an FBA?
No, it's an FSA, flexible spending account. Okay. So it's a flexible spending account. Government has attacked these things a little bit. Government set it up, and then they attack what they don't like. So they used to allow you to take $5,000 a year. Now it's an indexed rate that's around $2,500 plus. And the problem with flexible spending accounts is manifold. Number one, because you have to if you're an employee, you have to take the money out of your account or out of your pay to put it into that account. You lose use of that money during the course of the year.
Yeah.
Okay. And if you don't have those expenses by the end of the year, if you don't spend it by the end of the year, you lose it. It goes back to the employer.
Yeah, I had that happen to me at Xerox. Right. We'd be scrambling in December going out, well, I might as well go out and get me some $500, $600 prescription sunglasses.
Right.
Because otherwise I'm going to lose the money.
Yep. Or go to the dentist and get all your... that's why the dentists are the busiest in December than they are the whole year.
I didn't know that.
Everybody's scrambling to get all their dental work done. It's not like you don't go to a doctor and say, well, I need my gallbladder taken out just because it's the end of the year. But you do go to the dentist. Okay? So, it's... Might
as well yank that appendix, Doc, because, I don't want to lose my dough.
I got extra money, Can you take my appendix out, please? So anyway, so the flexible spending account has a number of issues with it, for the employee and the employee.
Right.
Most people don't stop and think about the risk that the employer takes.
No, I didn't think about that.
There's a huge risk the employer takes. Let's assume that you want to save the $2,500 a year that government allows you. Okay, and you want to save that all today, and it's now January. You take $200 and some odd dollars out of your paycheck to put it into the account, and you decide, you know what, I'm going to go down and I'm going to get that laser eye vision taken care of right now. So you go down and you spend $2,500, and you've saved $200 for it. That doesn't sound right, does it? Okay, but you can do it. Okay, not that I'm encouraging this to employees, okay?
Right.
But, if you have that account set up, you can go down and spend $2,500, get reimbursed $2,500 tax-free for turning in the receipt for that, and then you're required to save the $200 a month for the other 11 months just to pay for it. Okay. Well, what happens if you do all that in January? In February, you either quit or get fired. Guess what? Your employer just paid for your laser eye surgery. Okay. Again, I'm not encouraging this because I will have many employers come and tax me on it. But that's exactly what happens. So, what do we do? How do we correct that? How do we correct all of the problems that the employer has with a flexible spending account, all the problems that the employee has with a flexible spending account? It's easy. Okay. You're listening to Close Up on San Diego Business. We're here on KCBQ, streaming live at AM1170theanswer.com. Give us a tweet at CloseUpSD. Email me at barry@closeupsandiego.com or find our page on Facebook. We want to hear from you. I'm your host, Barry Waxler, here with my co-host, Andrea Kay and Urban Miaris. And I was trying to put a little suspense in there for a second. I'm sure that worked well. The answer is there is what we call a supplemental health insurance product on the market today. And that's what Bill McCracken and Gary McFadden, who were in a year or so ago, were talking about. This is a method to save money on taxes for every employee. Which, by the way, there's a benefit to the employer for the employee to save money on this thing. Okay, and I'll go through that in a second. It's a supplemental health insurance product that converts a lot of your income that is spent for medical care, unreimbursed medical expenses. It converts it into a premium, and you get reimbursed on your paycheck. I know that's complicated, so let me simplify it. Okay, what you do is you incur the expense. So let's say you have laser eye surgery.
Okay.
Okay. You go out and you spend $2,500 on laser eye surgery. You haven't saved a dime because this program does not require the savings accounts. You turn the receipt in. The receipt is aggregated with all receipts from that company, goes over to the administrator of the plan. They then give guidance back to the payroll department. The payroll department will legitimately deduct that $2,500 from your pay and reimburse you as a tax-free reimbursement on the same paycheck. You haven't had to save the money. Okay. You don't have to worry about spending all your savings by the end of the year because there are no savings accounts. And you get the same benefit out of it by having that $2,500 made tax deductible for you on the paycheck by virtue of it being essentially a copayment or a shared premium expense on the payroll, because premiums are deductible on your payroll. Okay? Now, what does that really do? Let's talk about the ultimate benefit for the employee. The ultimate benefit for the employee is they get to save on their federal taxes on the amount of money they spent. Okay? They get to save state taxes on that money they've spent. In California, we have a 9 to 13%, well, probably 6 to 13% state tax, depending on what your income is. And they get to save on their Social Security if they were self-employed. It'd be a self-employment tax. Most of these people are W-2, so it's the 7.65%. So if you're an employee and you're in let's say a 28% tax bracket, you got 28% federal tax savings, you got 9.3% state tax savings, and you got 7.65% FICA or Social Security taxes. Okay, that's almost 40 to 50%, depending on what your tax bracket is. I just used an example. So why does the employer want to do this? Is because they're gracious and they want to help.
Yeah, what's in it for them?
What's in it for them? Okay, that's an easy one. Okay. When you are a W-2 employee, what taxes does your employer pay for you? Do you know?
Well, they pay part of the payroll tax.
Right, the Social Security tax.
Yeah.
So if you paid 7.65%, they match 7.65%. So the employer, if you're reducing your payroll by $1, that's
less they have to pay.
That's less that they have to pay. Plus, there's one other piece that the employer doesn't have to pay, is if you reduce the payroll to reduce the payroll tax, you also reduce the payroll as exposure to workers' compensation. Okay, so if you have a white-collar company, you're going to have a 1 or 2 or 3%, workers' compensation expense. What if you have roofers and window washers, which are the other extreme?
Right.
Where you have 50 to 75% of their payroll goes to the tax. I know people don't believe that, but that's true.
Oh yeah.
Okay. Now all of a sudden, the employer gets to save a whole big bunch of money.
Right.
So, there's a lot.
It's a win-win.
It's a win-win.
That's what we call a winner-winner.
Right. And the beautiful part about this, and this is the one thing I didn't mention, and this is aimed at employers. Okay. If I go in and I try to set up a flexible spending account, the program the government set up for me, I have to go in there and I have to get a reasonable percentage of employees to participate. Otherwise, the highly compensated or the executives of the company get kicked out. Okay? Right. Which means I really need to get a 50, 60, 75% participation rate. When I have all that, and if I have lower paid employees, they're not going to participate because they can't afford to give up that portion of their pay for that particular month until they spend it, no matter what it saves them. Okay?
Yeah.
The programs that we're talking about, because they are insurance-based products, are voluntary. Okay? Voluntary meaning that we can take one employee and not the other. The only real restriction that we have here is if you own an S corporation or you're I think it's over 5% shareholder of an S corporation, you can't participate. But if you have 1, 2, 5, 10, 20, 100, 1,000 employees, and you put this in, there's huge numbers coming back for you. Okay? You may not be able to participate on an S corporation, but you're doing a great service for your employees, and you're making it work for them. So that's just one way that we can help you stop bleeding cash. There's a lot of great stuff, and I encourage our listeners to call me, email me, text me, however you can get to me, and get a copy of the book. It is on Amazon. Just search on Amazon, Stop Bleeding Cash, and you can go in and buy a copy of the book. If you have a Kindle, you want to do an ebook, I think it's like $3.99 or something on Kindle. It's cheap. And the value that you get out of this. And here's what I want to tell listeners.
Okay.
One of the things I learned many years ago is you have to draft information for the masses, not for just, a specific target of who you want to listen to you. Okay? Mm-hmm. So when you write a book, you want people to read your book. You have to put it in 8th grade reading language.
Right.
Okay. So that's what we've done. I've written the book and I've brought in other experts to help me with writing the book that drafted it in an 8th grade reading language. Okay. Mm-hmm. It's like insurance and securities and CPAs and attorneys. We all have our own language.
Right.
And, we're used to it because it's internal and we try to communicate that with outsiders. Doesn't work.
Right. I mean, it's like if doctors were writing a book about, some complicated illnesses and treatments, nobody would understand it. They would have to try to write it in a way, there's industry jargon and stuff. And that's especially important given the fact that it's not just industry terminology that can be confusing, but money is so scary and intimidating to people. And so you've written it in a way that takes the intimidation factor out of it.
Absolutely.
Anybody can understand. It's simple and easy to understand, and it's not scary or intimidating.
Yeah. And Barry, what you're saying is, most business people, like I tell them, you got to stick your head out the window once in a while.
Absolutely.
Yeah.
So into their little world.
Right.
And talking with someone like you is so critical.
Thanks.
They're bleeding crazy. They're bleeding internally.
Yeah.
Well,
it's just terrible.
I know we're running short on time and have to get to a break. The reality is that get a copy of my book, Stop Bleeding Cash. You can get to me at barry@closeupsandiego.com, and I'll send you a copy. Taxes are the biggest aspect. If I can save you on taxes, and most people, whether employed or self-employed, I can generally get to about a 10% of income. Okay?
Ooh.
Just by doing a little bit of investigative work.
And it's all legal.
All legal. What we do is we package it up. We get the blessing of your CPA or tax advisor. We'll get the blessing of your attorney, or we'll bring your attorney in to help you, or we'll place you with an accountant or an attorney if you don't have one. Mm-hmm. Either way, taxes are the number one thing that's the biggest expense you'll ever have. Home loans, we can teach you how to deal with home loans, credit card debt, unsecured debt, how to maximize how you spend money on life insurance premiums.
College educations, you work with college planning.
Absolutely.
That's a huge expense for people these days.
And we will work with specialists to help them accomplish things. So anyway, that's it. Call me or email me at barry@closeupsandiego.com, or call me at 619-295-5920, and let's talk about it. So this is Close Up on San Diego Business here on KCBQ, streaming live at AM1170theanswer.com. Send us a tweet at CloseUpSD, or just find our page on Facebook. You can always email me at barry@closeupsandiego.com. Let me know what you think. I'm your host, Barry Waxler. We'll be right back after a word from our sponsors.